If you guys are just coming in, today's topic is going to be on how I trade Fibonacci, and also a little bonus, I'm going to go over how I trade bull and bear flags using this Fibonacci technique. So first off, if you guys don't know what we're talking about, I'm talking about the Fibonacci sequence, the Fibonacci drawing tool here on TradingView. So I have modified my Fibonacci tool a little bit. So if you go to the Fibonacci settings here, these are my current settings. If you guys want to match them, you can. Go ahead and pause the video on YouTube and you can match my settings. So I turn off the trend line. I change the numbers around a little bit. I turn off the background and I change the colors. So the levels that I use, I use the 0 line, the 1 line, the 0.618, 0.382, the negative 0.13, negative 0.618, 0.5, and negative 0.5. So the reason I use the negatives is they act as an extension. As you can see here, they act as an extension tool, which I'll go over later in the video. But when you're not using those extensions, the default levels are your 0 and your 1. So that's going to be your flagpole. And then you have your retracement numbers that I only use the 382, the 5, and the 618. So there are two other levels that are typically used on Fibonacci. It's the 0.236 and the 0.786, I believe. I might have been off a little bit on those, but one is about 75% and one is about 25%. I don't typically use those. I only care about the ones that are around the 50% range. So that is my tool. That's what we're going to be using during the video. So let's get started. So the basics of Fibonacci, this is one thing that people heavily mistake, and they do backwards. It's quite funny because I see it very, very often in crypto. I don't see it very often in equities trading, but a lot of crypto traders have seemed to gotten their Fibonacci's backwards. And I've seen a lot of crypto traders. So for example, if I wanted to take the Fibonacci from this low to this high, I've seen Fibonacci or crypto traders grab the high and then pull it down to the low. Now this gives you an upside down fib. This fib is backwards. You always want to draw your fib from left to right. So if you're taking a bullish fib, which is a bullish move up, you always want to take it from left to right. You grab that lower level, and then you grab the higher level. So if you're drawing a bearish fib, so like if we wanted to take a fib from this high to this low, you always draw from left to right. You grab that high, and then you grab the low. You never draw right to left. It's always left to right. Okay? So if I were to look at this impulse here, the 2019 bull run of Bitcoin, if I wanted to trade Fibonacci, what I would do is I would grab the lowest point, and I would take my Fibonacci tool and draw it to the highest point. Now, we have this discussion on every single video almost. People always ask me, do you take wicks? Do you take bodies? And I always say the same thing. It really depends. It depends on how extended the wicks are. Does it seem like the wicks are being respected? Was it just kind of a one-off like scam wick, or was it an actual price level that was being traded? It really depends on how the wicks are being respected. And if it doesn't look like the wicks are being respected, I'll take the bodies. But if the wicks are being respected, I'll take the wicks. And even if the wicks are not that big, like these wicks are not very long, I'll take the wicks. So for this example, I'm going to be taking the wicks. So I'm going to grab the lowest point of that impulse, and I'm going to grab the highest point of that impulse. So let's just imagine that we don't see any of this price action. Let's imagine that we just had this high, we came down, and we have a little bit of price action, but let's pretend like we don't have any of this. Okay? So I'm going to grab the low. That's going to become my 1 line, your 100% retracement. And I'm going to grab the high, which is going to become my 0 line. Let me make sure these are about as perfect as possible. These look pretty good. Okay. So once I have my 1 and my 0, then I can start to look at my levels. I have the 0.382, the 0.5, and the 0.618. Okay? Now, the 0.382, I call this the soft fib. I don't really know exactly why I started using that name, but it's the name that I've given it since I started calling it that. But I call the 0.382 the soft fib. The 50 is just the 50% retracement. And the 618 is the golden ratio. So you have your golden ratio, your 50%, and your soft fib. Okay? So if this was an incredibly bullish move, if this was an incredibly bullish trend that wanted to maintain a very bullish trend, it needs to stay above the soft fib. The soft fib is going to act as kind of that first form of support if we're using it for a bullish trend. It's going to become the first form of support, and it needs to hold if we are going to maintain that very strong uptrend and break into another high. Okay? We kind of see a little support come in here during the first test of the soft fib. You can see this little bounce right here, and then we pop back up and almost test that high. But then we fail back downward, and we test the soft fib again. But this time we kind of break through the soft fib, and then we give it another test, break through it a little bit again, and then we try to pop higher, but yet again, we have a lower high. Okay? If you haven't already watched my market structure video, go ahead and do that. It will be posted tomorrow. So this video, once this video is posted, it will be on my channel. But if you haven't already watched it, please watch that video because it will go over lower highs and higher highs and whatnot. And that's going to be very important when you're trading Fibonacci. Because when we come down and test this soft fib, we really want to see a higher high form off of that bounce. Okay? If we don't see a higher high form off of that bounce, then it's very likely that we are going to see a test of the next Fibonacci level, the 50%. Okay? So we tried to find support on the soft fib. We pushed higher. We were not able to make a higher high. So your next point to target is that 50% retracement. Okay? So now we can scroll down. We can look and see how does it react to the 50% retracement. It doesn't really react to it at all. It breaks through it, and then it closes on it, but then it uses it as resistance multiple times. And then we fail down towards the 618. So the 618 is that line that must hold for the uptrend to continue. So if I were looking at this entire market for 2019, and people are always like, is it a bull market? Is it a bear market? Yada, yada. So what I typically look for is the 618, has it been broken? Is it being broken? It's not being broken. The 618 from this bull trend has been held. So as long as that 618, that's about 62% retracement, as long as that level holds, you're still technically in an uptrend. In my eyes, if you're trading your my Fibonacci technique, you're still technically in an uptrend. Okay? Now, one major thing that I do is I call this 618 to this 50%, this little zone in between, I call this the buy zone. It's a buy zone if you're trading a bullish trend. It's a sell zone if you're trading a bearish trend, which we'll go over once I'm done here on the bullish trend. So this little section between the 618 and the 50% is a buy zone. So if you were looking at price, and let's say, like I said earlier, let's pretend like we don't see any of this. So if we were looking at price and we just saw that high form, we saw this pullback, we see that failure of the soft fib, it's unable to make a higher high. Where am I targeting to enter my longs? Where am I looking for a pullback? So I would be looking for a pullback in the buy zone. Now, typically, I like to take the buy zone of the buy zone. So typically, I like to take that 50 to 618% retracement of the buy zone, which actually gives you that beautiful little pullback right here. Look at all these wicks. This little pullback here. Now, you did have a swing failure. You did break that buy zone of the buy zone. You broke it for a little bit, but then you bounced right out of it. So you never were able to break the 618 of that entire trend. So even though you had that swing failure here, that was actually just testing the 618 of the entire move. So going back to what I was saying, I typically like to take the buy zone of the buy zone. That's where, if I am not going to be watching this live and I just want to throw some orders at it, I will typically throw my orders around that range, around that 50 to 60% zone of that entire buy zone. So if this was my entire buy zone, this entire range here, where I would be placing my orders is in this little zone here. So like I said, the buy zone of the buy zone. Okay, let's get rid of this. So now let's say that my orders got filled. Let's say that I was being patient, I waited, I put my orders where they should be, they got filled. Now, how am I trading this? Where is my stop loss? Where are my targets? Okay. So if my orders got filled here, let's just say I longed this little pullback. My stop loss is going to be below the 618. So my stop loss is going to, you can put it as close as you want to see. It really depends on how much risk you want to put up for the trade. But I wouldn't put it like really close. Like I wouldn't put it right on the level. I wouldn't put it like right next to level. You want to give it some room. So I'd say put mine like right here around like 10%, let's say. And then my targets are going to be the Fibonacci levels. So my targets, if you want a really close target, I typically don't use this one, but if you want a really close target, you can target the 50%. Now, I would only use this in scenarios where, let's say your longs got filled, but you're really scared about your longs and you feel like it's not going to break out to the upside, and you think that it's very likely that a downtrend is coming. Now, if you're scared in that sense, you can use the 50% level to take profit. But like I said, I rarely ever use that level. So typically, I take most of my profit, or depending on how long of a trade I want to take, you can take 50% of your profit or the majority of your profit at that 382 level, that soft fib. So here's your entry. Here's your stop loss. And then you can close half, or you can close 75 to 100% of your trade at that soft fib. Now, pretty much every single time you take this trade, you are going to have a positive R to R. Because the way the Fibonacci is built, the way these levels are going to be extended from each other, the 618 is always going to be the same distance from the 50 to the 50 to the 618 is always going to be the same distance, and the 382 to the 618 is always going to be the same distance. Now, obviously, percentage wise and dollar wise, these are going to be different. But for the sense of R to R, if you take your trade where I take my trade and you put your stop loss below the 618 and then you target the 382, you are always going to have a wider range to your take profit than you do to your stop loss. That might be a little confusing, but if you do it a few times yourself, you'll understand what I'm saying. I don't want to go too far into that because I don't want to over confuse a very simple topic. But yeah, so this is going to be your entry, the buy zone of the buy zone. Your stop loss is below the golden ratio, below the 618. And then you're going to target the Fibonacci levels, the 50, the 382, and then you can target the full retrace if you would like. But that is going to give you a very wide target. So if you want to leave that 236, the 236 would be somewhere around here. If you want to leave that 236 Fibonacci level, you can also target that level as a take profit. But what always remains certain is your stop loss should be below the 618. Your targets can really be up to you, but your stop loss should always be below the 618. Because like I told you earlier, if that 618 is broken, that is typically going to be when your uptrend has completely shifted into a downtrend, or your bull market has completely shifted into a bear market. Okay? So let me just do a quick recap. You always want to take left to right, your low level to your high level for the bullish Fibonacci. If you're taking a bearish Fibonacci, you want to take your high to your low, which will give you, once again, left to right. You never want to draw your Fibonacci right to left. That will give you a backwards Fibonacci. For a very strong uptrend, you want the soft fib, aka the 382, to hold, and then once it is held, you need to see a higher high form before you fail downward. That will give you a very strong uptrend. So for example, this should have held and pushed into a higher high, which it did not. If it does not push into a higher high, you want to target the 50 and 618. You can target the buy zone. Once the buy zone is tested, you can take a trade towards the middle of the buy zone with a stop loss below the 618, and then you can target the Fibonacci levels. Okay? That is everything that we've gone over so far. Now let me talk about using this in a bearish scenario. So if we were to see a bearish scenario here, we see that top of Bitcoin in 2019 towards the local low of 2019. That gives you that left to right Fibonacci. Now, a good way to check that you're drawing your Fibonacci correctly, the 618 should always be farther away than the 50. Okay? So like if I drew my Fibonacci from the low to the high, the 618 is farther away than the 50. Okay? So for a bearish scenario, we have our high to our low. Same thing is said. If this were to continue a very strong downtrend, it must fail the 382, the soft fib, and it must break into a lower low. So if this were to pull back here and create a higher low, then that soft fib has not been maintained, and this pattern is not going to play out. So if that were to happen and we see a higher low be put in here, like I said for the bullish scenario, you would target the 50 and the 618. You would target the sell zone. Because this is a bearish Fibonacci, this is now a sell zone. This is not a buy zone. Okay? So same thing. If I wanted to place orders here to take this trade, I would look for the sell zone of the sell zone. Oops, I did mine backwards. Let me, oh no, that should be right. Here we go. So you would look for the sell zone of the sell zone, which would give you basically right here. That is where you would place your orders, around that 11,000 range. So if this were to push higher, we would look to be selling around that 11,000 range, and your stop loss would be above your 618. So let me get rid of this. We'd be looking to sell around 11,000. Stop loss above the 618. And then, like I said, you can target the 50 if you want to, but that's not usually a good target. And then you want to target the 382 as your main target. And then you can further target like the 236 or the full retracement. And that would give you your Fibonacci setup on that bear flag. Okay. So let me go into a little bit more advanced. Let me make sure I cover everything here. So yeah, we failed. If we're looking at current price action on Bitcoin, you wicked all the way up to your 50%, but you were not able to ever close above that 382. So in my Fibonacci technique, this is still a very strong downtrend because we are still not creating a higher low and we are heading back down towards that low that we have marked on our Fibonacci. Now, obviously, you can take into account other technical analysis. Like, for example, this is kind of a falling wedge here. So typically falling wedges are bullish, but we're just going to talk about Fibonacci here. So just talking about Fibonacci, this failed the 382. We have not put in a higher low, so you would still be targeting these lower levels. Okay? So now let's get into a little bit more advanced. So if we were to break this lower level here, if we were to break into a new low, I typically use the 0.13 or the negative 0.13 if you're using the extension. This is a 13% extension. So right here is my 0.13. This is a 13% extension. So what that means is, if we were to fall down here, this is the fakeout zone. So this is typically where you will see deviations or fakeouts. So if we were to come down and break this low, if we start to retrace before breaking the 0.13, that is most likely going to be a fakeout. Okay? Because this is the fakeout zone. This 1 to 0.13, that 13% extension. Everything in between that 13% extension is the fakeout zone. So how do we know, is it going to be a fakeout or is it going to be an actual break into a new low? So what I like to see is if this were to come down here and break this 0.13 and then retrace, this is very likely it's going to continue downward. But if this were to come down and start to recover before breaking this 0.13, it's very likely this will become a fake out and it will push back towards the upside. Okay? So on that initial break of that new low, it needs to break that 0.13. It needs to break that fake out level. If it doesn't break that fake out level, very likely that it will become a deviation and we will push higher. So if you guys haven't already watched my accumulation distribution video, watch that video. You'll know what I'm talking about when I say deviation. So it could form a deviation here and then regain that low and start to push higher again. So we always want to see a break of that 0.13 before we begin to head lower. So same thing can be said for a bullish level, okay? So if we were to take the Fibonacci from the low to the high, let's go to this on a weekly to make it easier to see. Okay, so if we were to break out here, let's just say Bitcoin starts to rally and then we break out, right? If we cannot break 15,000 before retracing, it is very likely it is going to continue downward. It's going to reverse and start to move downward. But if we start to head higher here and then we break that 0.13 before retracing, and typically on that retrace, you want it to hold the zero line. So if we break that 0.13, it can pull all the way back to the zero line, but you typically want it to hold the zero line. You don't want to see it regain that zero as resistance. Okay? So you want to break it on your first attempt before pulling back. That will indicate an uptrend. But if we if we don't break and we come back down, that's very indicative of a deviation and we might continue lower. Does that make sense to everybody? Do you guys have any questions on that? Okay, so if we do break our 0.13 and we do continue our uptrend or our downtrend, you'd ask yourself, what am I going to target? So this is very helpful for things that are entering price discovery. So if things are entering, like for the SPY, let's take the SPY for a very good example here. Let me pull up the SPY. So if things are hitting all-time highs, right? And you're like, okay, well, if it's in an all-time high, there are no levels for me to target. I have nothing to base my levels off of. The only thing that you can really use that's reliable is Fibonacci extensions. Okay? So if I was looking at the SPY here, which is the S&P 500, if you guys don't know, let's say I take this low here all the way up to our previous all-time high. And what do we see here? We see our 0.13. That's your initial breakout level. We're currently in the fakeout zone. So on today's candle, the SPY nearly broke the fakeout level, the 0.13, but it wasn't able to. So if tomorrow's candle or next week, if the SPY starts to push lower back towards 300, it's very likely that this is going to become a deviation and the SPY is going to go back down and then reattempt to break out. So it can always reattempt. So if it were to fake out here and then fail, it can always come back and reattempt. But you always want to see it break that 0.13 before retracing. Okay? So right now we don't know. Right now we're not sure, is this a fake out or is it going to break out? Because it's still continuing that upward momentum. So keep an eye on the SPY. If this pulls back, this is very likely to become a deviation and you're going to head lower. But if this breaks the 0.13, what are you going to target? Okay, that's what we're going to talk about here. You're going to target the 50% retracement and the 618 retracement. This becomes that sell zone of your breakout. So let's say you take the breakout on either this attempt or the breakout of this level here. This becomes your target. The 50 to 618, that zone that we talked about earlier. So this would be your buy zone if we were to fail. But if we were to break out, this becomes your sell zone. It's that same technique, the 50 to 618. 50 to 618. It just really depends on what price is doing. So this would be your trigger. The 0.13 would be your trigger. Or you can take the preemptive trigger of the break of the high. But like I told you, you could see a fake out in this zone. So just know if you take that early trigger, you could easily see a fake out and you would be losing your trade. So it really depends on how risky of a trader you are. Can you manage the risk of getting in early, or do you want a more a higher probability trade? So obviously, if you get in early and you're right, you're going to make more money. But if you get in early and you're wrong, you're going to lose a trade that you wouldn't have lost if you would have been patient. So either one of these can be your trigger, and then where you want to sell the bulk of your trade is towards that sell zone. Now, depending on how big of a Fibonacci you draw yourself, that sell zone is going to be pretty far out. So you really have to look at a chart and figure out, where am I going to draw my Fibonacci? And depending on what the chart looks like, the SPY is kind of a bad example because the SPY is just constantly in an uptrend. It's just constantly breaking out to new highs. So the SPY is not the best example. But what I would typically do when I'm drawing my Fibonacci is you look for the last major trend shift, like the last major impulse that shifted your trend. So, for example, if we saw like a major impulse down and then you shifted into an uptrend, that is the low that I would take. Now, obviously, these lows are just pullbacks. These are not major trend shifts. That's why I grabbed this low here, because that is a major shift. You see a very big sell-off, and then you see a very strong shift in trend. That is why I took that low. You don't want to take the lows that are just like pullbacks. Those are not going to give you very good Fibonacci levels. So if you wanted to go farther out, you could have taken like this low here, and look at what happens here. Look at what this turns into. This gives you a perfect buying opportunity. If I can line these lines up, it gives you a perfect buying opportunity using my technique on that wick. Look at that wick there. Look at where it bounces. The buy zone of the buy zone. So if you were to go all the way back and take that shift back in 2016, where you see that major correction, and then you see that bottom shift into an uptrend, that is where you would take your low. And then if you drew your Fibonacci all the way towards the all-time, or actually, sorry, looking back at this is a mistake. So this is actually good that I made this mistake, because I want to go over this. I just made a very common mistake. So what people do is they'll draw their Fibonacci from low to high, right? But everything before this level is hindsight. You cannot trade anything in between these levels. So I just made a very common mistake. So let me clean this chart up and I'll go over exactly what I just did. This was actually not scripted. I'm kind of glad I made that mistake though. So everything in between your high and your low is hindsight. So you can't say that this bounced out of the buy zone because that buy zone wasn't even created yet. Does that make sense to you guys? So this buy zone was only created once we grabbed this high. So now that we grabbed this high, then our Fibonacci levels can be used. Everything after this level. But everything before this level is hindsight. So people will fall victim of this because they will do exactly what I just did. They'll draw their Fibonacci and then they'll see this very beautiful test of that buy zone and they'll be like, oh, that is reacting to the buy zone. But it's actually not reacting to the buy zone because that buy zone didn't even exist yet. So make sure when you're drawing your Fibonacci's to always double check that you are not basing these trades that you're backtesting off of the levels that happened in between your low and your high. Sorry, I probably just confused you guys because I kind of made a mistake mid-video, but anything in between these two levels cannot be used as a backtest. Okay? Let me go back to what I was saying. So back to what I was saying, when you choose which levels you want to use as your low and your high, you always want to be looking for strong levels that acted as a good impulse or a good trend shift. So like this was a good impulse, This was a good impulse. You could go all the way back to like this one here, maybe this one here. But all these little levels in between, these are just pullbacks. Those are just pullbacks. Those are not major levels. So finding the proper level is going to be one of the hardest things for you guys to do if you're new to this technique. Let me see. So let's look at this, for example. So if I were to take this low here to this high here, look at what we see here. So this is beautiful because everything after these levels I can use with my Fibonacci levels. But everything before these two levels, this is all hindsight. So don't worry about any of this. Everything after these levels I can use, okay? So once this high is created, what do we see? We see a pullback. You were not able to make it to your soft fib, and then you started to push higher. But then what do we see here? What did I tell you guys? If it doesn't break the 0.13, it is very likely to become a deviation, and it's going to head back down. And that's exactly what we saw here. It was not able to break that 0.13 level, and we became a deviation. So if you become a deviation, you just target your Fibonacci levels. You have the 382, the 50, and the 618. Now, we broke the 382, but look at where we bounced. We bounced almost to the penny off of the 50% retracement. Now, if you were waiting for the buy zone, you actually did not get filled on this one. This was a very strong bounce. It bounced off the 50. Now, typically, if you bounce off of the 50, but before you test the 618, that's going to be a stronger bounce because you are showing that price is not able to get back down towards that 60% retracement. It's not able to push lower. The buyers started buying it up early, and that's why you saw that strong bounce off that 50%. Okay. So yet again, what did we see here? We saw another attempt to break into a new high, which was not able to break the 0.13 retracement or extension, excuse me. So then we failed lower, but then it tried again. And then look at this attempt. This attempt broke the 0.13, pulled back, used the 0 as a support, and then support again, and then we broke out. So like I told you guys, if you break the 0.13, it's very likely that you will go higher. If you don't break the 0.13, it's very likely that you will go lower. So we broke the 0.13, acted as support, and then we went higher. Now, if you were still trading the same Fibonacci here and you did not adjust your Fibonacci to your new highs, your targets would be that 339 to 351 level. That is your sell zone. Now, obviously, you can target levels in between because you have like the 236 and you have some other levels, the 382 in this range here. You can target those levels as well. But just to make my Fibonacci clean here and to use kind of the same technique, I do not use those levels in between. I typically look for that longer extension. Now, this technique, let me go back to Bitcoin here. This technique is generally, I only use it for bull flags and bear flags. So typically, when I see a strong impulse like this, and then I start to see a high form, that is when I will use my Fibonacci technique. Same thing towards the downside. If you see a strong impulse, and then you start to see a flag, that is when I will use my Fibonacci technique. Now, to maintain that bull flag and bear flag structure, you need to make sure that you're looking at volume. So for a bull flag to be a bull flag, you want it to have a high buy volume and then low sell volume. So when it's flagging, you don't want there to be a lot of volume. And then when it starts to break out again, you want to see that volume start to pick up. So high volume, low volume, and then you want to see the volume start to pick up again once you start to break out. So same thing with the bear flag. High sell volume, low buy volume, and then high sell volume. Now, if you use that technique with the Fibonacci technique, you can find some very good trade entries and exits. But all right, guys, that's basically it for the Fibonacci video. Do you guys have any final questions when it comes to my technique trading Fibonacci or trading bull flags or bear flags? I don't see any questions coming in. I'm going to go ahead and end the video on that. I do appreciate you guys being here for our live video. If you guys are watching the VOD on YouTube, I also appreciate you guys coming by. This video will be uploaded the next few days if you guys are watching live. As always, if you guys enjoy the content, please don't forget to hit that subscribe button on YouTube, and I will be releasing more videos in the future.